For Morningstar, I'm Jeremy Glazer. Joined today by Bob Johnson. He's our Director of Economic Analysis. With manufacturing and housing not being a big help to growth, will the consumer be able to come through? Bob, thanks for joining me.
Great to be here today.
So let's start with some data that we got this week. First up is durable goods.
Yes.
We still aren't seeing a lot of excitement for spending there, are we?
You know, absolutely not. It's been tough for manufacturing in the last year, and certainly this was no relief this week. The overall durable goods number was flat month to month. Some of the month-to-month categories looked a little better, but on balance, there were a lot of categories that were down. I was hoping that it would be a little bit better spread, at least. I could say, well, half were up and half were down, but it really looked like a pretty negative bias to the durable goods orders. And those are important because they're kind of a lead factor when we're trying to figure out what's happening in manufacturing. I'll say maybe the non-defense capital goods did look a little bit better this month, but not by much. The year-over-year data for both categories have been stuck in neutral for about 4 months now. In the case of all durable goods, excluding the motor vehicles, we were still down about 2%. And if you do the non-defense capital goods, we're down about 4%, and that isn't much different than we've been for a long time. So, unfortunately, no great recovery coming there. And unfortunately, there was one little kick in the pants. In addition to kind of the new orders not being so great, they also disclosed shipments in the data, and that's what's used to determine the equipment category for spending in GDP. And that number looks like it was down. It's been down a couple of months now, and so it looks like that will be a subtractor from the GDP calculation yet again. And one amongst many factors that has caused the GDP now kind of automated GDP forecast for the quarter, for the third quarter, for September to drop from 2.9 to 2.8%. Recall they started out at pretty close to 4%, and they've kind of been weaving their way down ever since.
So definitely no help from manufacturing. No. And then housing, another area that we thought could be potentially a driver with new home sales, those were down as well.
Yeah, they were down month to month. And the numbers are so volatile. Even my 3-month moving average technique doesn't take everything out. You almost have to go back to a rolling 12 that takes a full year into consideration. And there, if I look at the rolling 12, again, we've kind of been stuck at kind of 10, 11%, adding 12 months together comparing to the previous 12 months. And we've been in that, kind of 10, 11, 12% range forever. Again, not accelerating, not decelerating either. So that's the good news, but we need help right now in the economy when the manufacturing is still falling. The auto sales have been difficult. We need something to help, and housing is going to be the same as it has been at best.
We've talked recently about you have some worries about the economy because of things like manufacturing not helping and housing not helping. So it seems like the only thing left potentially is the consumer. Do you think the consumer can kind of ride to the rescue here and just continue to keep buying goods even with some of these other sectors looking weaker?
Well, that's certainly the wild card. I'm very worried and very concerned about the economy because a lot of the key drivers that I've been looking at, that you mentioned a few of them, but especially autos and jetliners and some of the shale stuff, have all kind of dropped off, and there's really kind of nothing there that I can see to replace it. And the one wild card is the consumer, which is 70% of the economy. And to me, it looks like the inflation rate for the consumer is coming up, and employment growth may not look so great, and that worries me about the consumer. Again, I even hate to bring it up, but I looked at the sentiment data seems to indicate the consumer is in the best mood in a long time. And, if I'm wrong on anything about this slowing economy, even the potential for a recession next year, the reason I'd be wrong is the consumers dig into their pockets and spend some of their savings. And that would really be one of the ways to do it. And the sentiment indicators certainly did look positive. But again, my sentiment indicators, what I like to look at, well, auto sales haven't been doing so great. Housing sales aren't wonderful. So that's certainly worrisome. And even the restaurant sales, we'll see when the data comes out, but certainly they haven't been lighting the world on fire like they were for a period of time. As grocery prices fall so much, people are not going out to eat as much or splurging on it. And so You can't look at those three things I look at for sentiment, and they don't look so good. But I will say, if I'm wrong, there's certainly some out there that say sentiment is strong, according to the surveys, and if I'm wrong, that's why.
So when that data comes out, you're really going to be looking for those three things: restaurants, autos, and housing.
Absolutely. They're a key focus area along with inflation.
Well, Bob, as always, I appreciate your analysis today.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.